Hello and welcome to a Wealth of Advice market update on the 25th of October 2022. I'm recording this less than an hour after our latest new Prime Minister, the third of the year, Rishi Sunak, has been sworn in after meeting Prince Charles at Buckingham Palace. So as you can imagine, over the last few weeks with everything that's been going on politically, it's been a bit crazy from the point of view of how markets have performed. There's no underestimating or you can't even play down the absolute carnage that was caused by the mini-budget by the previous Chancellor Kwasi Kwarteng. Jeremy Hunt has since tried to calm things down by reversing a lot of what Kwasi was planning on doing. And then one of the shortest Prime Ministers in our ever history, Liz Truss, she resigned last week. And now we have Rishi, who, if you watch the Conservative Party hustings over the summer, he was predicting that this fairy tale economic plan that Liz and Kwasi embarked on was going to end in disaster. Unfortunately, he's been proved right. And when I say unfortunately, the unfortunate side effects of what was created in that mini budget a few weeks ago was that UK government bonds have been sort of traded at a much lower value because the confidence in the UK government and what their plans are has just evaporated from the markets. Kwasi was quite arrogant and said, we're the government, we know what we're doing. Forget about the markets don't matter, markets go up and down, but we're on a plan for growth. The unfortunate side of it is the markets do matter. We're going to have another budget on the 31st of October, so next week. We're hoping that that is not going to be anything controversial, but the markets have calmed down. The markets like what they've been hearing in recent weeks, so hopefully from the UK investments point of view, this is the low point and things will pick back up from there. My colleague Matthew has recorded big chunks of this presentation as well, but there is definitely some things to be encouraged about. Inflation may have peaked. You do read negative stuff on the various news websites and newspapers and such like, which is saying it's going to be a bleak winter, it's going to be the worst Christmas people have experienced in a long time, but there is belief that inflation may be starting to peak in certain areas. Gas prices are hopefully coming down. Europe has stockpiled a lot of gas this summer because we've had a warm summer. We've been able to stockpile more gas. We're hoping that our economy in the US economy stays strong and we don't go into this massive recession. So maybe, just maybe, we are coming through towards the end of this really volatile period. That's not to say there might not be further falls from here, but you can start to see that some of the news stories coming through now appear to be a little bit more positive as to where things may be heading next.
They say that a week is a long time in politics, and we've definitely seen that in this week. Looking at the UK news, Liz Truss resigned as Prime Minister after 45 days in office, making her the shortest serving Prime Minister in UK history. As you can see on this chart showing the pound versus the US dollar, the pound rose after her resignation. However, it's still been volatile as a relation to the political uncertainty that we've seen thereafter. Sunak's first challenge is to deliver some economic certainty. Jeremy Hunt has ripped up almost all of Liz Truss's disastrous mini-budget and is due to present his new budget next week on Halloween, and we'll be interested to see what's in that budget, and we'll do another video to yourselves to talk through anything that's announced and the likely impact that would have to yourselves and to the markets. Looking at the facts and figures that we've seen in relation to the UK recently, government borrowing rose to £20 billion in September, which is up £2.2 billion from a year earlier. This comes from figures from the ONS, and the figure is the second highest for September borrowing since monthly records began back in 1993. Jeremy Hunt, even before Rishi was announced, said that it was governments would do whatever was necessary to drive down debt in the medium term. So again, we expect to see that filter through in the budget next week. An economist, Mohamed El Ereni, said the markets right now are in a wait-and-see mode. Immediate financial stability has been restored thanks to the actions taken by the new Chancellor, and the challenge now is for the UK to pivot to higher growth, and can it do this in a fiscally responsible way? The markets will be looking for three key things. They want to know details of a growth plan, and including verdicts by independent parties such as the OBR, and they want to have more details on what will happen to the energy price subsidy after the 6 months that we've had announced so far. We're also looking to say, what will the future fiscal actions be from this new government? UK inflation hit 10.1% in the 12 months to September. This means that prices are rising at their fastest rate for 40 years. The figure for August was 9.9%. September's figure is important because it's usually used to calculate April's increases in the state pension and other benefits. Liz Truss recently announced that state pensions will be rising in April, with the new state pension currently worth £185.15 per week, going up to £203.85. Again, we'll wait and see if there's any changes made to that in relation to Rishi Sunak and Jeremy Hunt's new leadership. It's not all bad news in relation to inflation. I was at an event last week where accountants and lawyers were talking about things that are affecting their clients in general. And one of the things that the economists presented was actually there's 3 reasons why inflation could be falling over the medium to long term. I've got a couple of charts here which talk us through those. The first one is in relation to world shipping. Again, supply chain has been a key reason for inflation. And with container and dry bulk shipping rates dropping, as you can see from this chart, that shows that global trade should be able to be eased and the cost of that should also be reduced. We've also seen here, when we look on a supply chain chart, that pressures have been eased or are beginning to ease, which means that inflation should go in the right direction, which is decreasing over the longer term. There's also an interesting story I read today in the BBC, and that's looking at the price of natural gas. Again, this chart here shows that there was a big peak, but has started to drop down quite dramatically. This is as we see global stockpiling increasing and also the expectations of a warmer winter. If this continues, we'll see energy prices fall and inflation should also reflect this. The BBC's figures said that the target was to fill storage facilities in Europe, and they were aiming to get to 80% of capacity by the 1st of November. It looks like this target's been met, and the data suggests that they're now nearly at 95%. This means that giant ships with fuel are currently on the coast of Spain, Portugal and the UK, waiting to top up those reserves if required, but equally they might delay those coming on shore to later in the year as prices change, but having the ability to access that gas when required is good for the infrastructure of Europe in general. Mortgage rates have also been dominating the headlines as interest rates have risen. As you can see here from this chart, we've got the average 2-year fix and the average 5-year fix shown there, and rates have gone up quite dramatically recently. UK housing prices are already showing signs of slowing slightly as a result of the uncertainty in general and the mortgage rates rises. We have nearly 1.5 million households will come off a fixed rate mortgage in 2023. So there'll be a lot of people looking to refinance that debt and looking to see what the mortgage rates are when this happens. So there'll be a lot of interested people who are delaying spending in the UK or thinking about the next move based on what happens with interest rates and mortgage rates in the next few months into next year. Moving on to global news, Joe Biden's top economic advisor has said the US economy has the strength and resilience to shield itself from a recession. The Biden administration is sticking to a view that the US will experience a form of a soft landing and will shift to a slower growth rather than a deep contraction as the cooling of job growth rather than mass layoffs. Last week, we saw the S&P 500 rise by 4.7%, including a 2.4% rise on Friday alone. And then the technology-heavy NASDAQ advanced 2.3% on Friday, capping at 5.2% rise for the week. Both these indices recorded their record gains since June, so that shows some positivity in the market there. The 2 key reasons for this were, one, a view that the Fed might slow down rate rises for December, and also that corporate earnings that were being reported were better than expected. There was an idea that they would slow down, but actually the numbers that they've seen in the data have been quite strong. This has had a positive impact on both US equities and US bonds, essentially debt. US midterms are only 2.5 weeks away. The only thing that matters there is whether Democrats keep control of both the House of Representatives and the Senate or not. Only if the Democrats could have control of both houses could they really advance their agenda significantly. If Republicans take control of either chamber, this would lead to a gridlock. Democrats keeping control seems very unlikely, and the bookies have that at maybe about 10%. But the good news here is that equities have tended to perform well after midterms in general. This is because political stability can lead to market stability, and in general, people can plan for the future. And the other thing to mention here is that markets are happy with gridlock, or at least they don't mind it, because in general, returns have been better after gridlocks, rather than with one party firmly in control. So we'll be looking at the midterms interestedly to see what happens next and how that impacts on the US markets.
So anyone who's watched the news earlier this week, you would have seen that President Xi across in China has been re-elected for a third term. The unusual thing about this is that after Chairman Mao left his role, I think in the 1970s, China passed a law to say that no president would ever stand more than 2 terms. But because this guy's been so powerful and he believes so successful, they've changed the rules, and he now has a 3rd term, which may become a 4th term, 5th term, depending on what goes on. Although China is a communist state and people feel it is a closed shop, that he will always get re-elected, he does actually have to deliver to the people, otherwise there'll be a revolt. So he is conscious of this, and he wants to get their Chinese economy growing again. China, I think we said on the last market update, has effectively been in a state of lockdown over the last 3 years. They've embarked on a zero COVID policy, so any outbreaks of COVID will result in millions of people being locked down. That's still going on. However, we do believe that we are coming to the end of this. Stocks and shares in China slumped, and China's currency, the yen, also weakened against the dollar over big concerns that what Mr. Xi is doing isn't right for the economy. We heard a fund manager speak a few weeks ago down in London who said you will have the socialist side of the party and the capitalist side of the party who obviously have different beliefs on how things should go, and it is firmly of the belief that the capitalist side now needs to push forward and make China grow again. I think the annual growth that was quoted at the party conference was 3.9% growth. That is a level of growth that UK and many European countries can only dream of, but from China's point of view, it is really low. Now, if China will start to reopen from its lockdowns and it can start to make growth increase now, that will be good for everyone. We can import cheaper goods and products from China, and crucially, as I say, from their point of view, once they do open more trade routes themselves and have more international trade going on, then you'll see China's GDP grow as well. So this, I think, is a very positive thing, that China are now talking about how they grow their economy from here. Yes, the market in the short term went down this week, but overall, if you'd invested in Asia over the long run, you've been rewarded. And as I say, it is an area that we will look at, and if we feel that portfolio should have more in this area in the future, then we will sort of do our research and make that happen. So we now come to that part of the update where we show how various stock markets have performed. The graph you can see on the screen now is how stock markets have performed since the start of 2022. The blue line at the top is the FTSE 100, which, although negative, is the best performing out of the 3 indices we've got listed there. And that obviously is because of the oil companies, BP and Shell, which dominate the FTSE 100, doing very well this year, as we've had obviously spike in the oil price as a result of the war in Ukraine and Russia, etc. FTSE 100 has come down in the last few weeks. Confidence in the UK dissipating after that mini budget we explained earlier, but just in general, if you look from from end of August onwards, when we had a bit of mini bounce in markets from the end of August down to the beginning of October, it's been very negative. You look at the S&P 500, the middle line there, the green line, hasn't done well at all, but you can see in recent weeks there's a little bit of a kickback up. This is the market that I pay most attention to, in so much as if the S&P 500 is performing well, everything else around the world should pick up and do well. The event I was at in London a few weeks ago, where we had a fund manager there who manages purely in the S&P 500, explained that he had $250 billion of funds under his management at the beginning of the year, and that is down 25%. So massive reductions you've seen there, and some quite huge companies have seen share prices come down. Microsoft, Apple, Amazon, all the big companies you've heard of. We've previously mentioned on these updates that Netflix saw a massive reduction in its share price. I think it was down around about 60% at one point this year. Netflix announced last month for the first time since all these bad news stories that they've added millions of new subscribers over the last month. So maybe certain parts of that are turning. And there will come a point when you look at those graphs there where market reach is a low point when big investors will start buying those stocks because they think they're cheap. Hopefully, we've come to that point where people will think this worry over recession, this fear of the war, etc., has caused markets to fall to such a level where they are cheap to buy, and maybe they start growing again. That's obviously the hope. As ever, when you look at investments, we need to remember that we're investing for the long term. The long-term graph there shows market performance over the last 5 years, and if you'd been invested purely in the S&P 500 over that 5-year period, which none of our clients are, obviously, because it would be mega risky putting you into one particular asset class, but the S&P 500 has performed very well. FTSE 100 still lagging down when you compare the two over that longer period, and as I say, as a result of what's going on within government and changes there, Brexit, etc., needing to get better, you would hope that the FTSE 100 over the long term starts to pick back up again soon. So as well as looking at long-term performance, I always think it's interesting to put in what the long-term volatility index has shown us, the VIX index. Any long-term clients who've seen this before will be familiar with the fact that when the VIX index spikes is when markets tend to fall thereafter, when risk gets really, really high. The 5-year chart you can see there shows what the VIX index did in 2020 when COVID came along, when it went off the scale, the highest the VIX index I think has ever been. And then we look at it this year, very volatile, wild sort of spreads. The 52-week high over obviously the last 12 months shows the VIX went up to 38.9. The lowest it's been in the last 12 months was 14.73, which would have obviously been at the back end of last year before things in Russia and Ukraine started to escalate. But as you can see on the chart on your screen now, when you look at the VIX index year to date, from the end of August when markets had gone all the way up, the VIX index came down. We then saw it rise again. Markets have gone down, but in the last few days, it's coming down again. So we're nowhere near those elevated levels that we've seen in previous years. Even earlier on this year, when the VIX index, as I say, got up to almost 40, we're well below there. So hopefully, more positive news stories coming through is calming the markets, and as a result of that, maybe the markets are now starting to turn, and we will see a buying opportunity in the eyes of the huge investors that will turn markets. So this is definitely an index we keep an eye on, but nothing to be worried about there, and it is coming down in the right direction over the last few days. So thanks again for listening to another Wealth of Advice market update. As ever, if anyone has any questions, queries, please don't hesitate to get in touch. Email, phone, text, however you get in touch, just do so. As I say, we'll send another update in a couple of weeks' time, when hopefully there hasn't been as much going on as the last few weeks, and hopefully the Prime Minister we have in place now is still in place in the next few weeks, and we don't have all that turmoil again. So thanks again for listening. Goodbye.